Welcome to the Broken Pie Chart Podcast, episode 325. I'm your host, Derek Moore. Moody's went and did it. Moody's did it. They downgraded the United States debt on Friday, stripping the country, I'm reading from a CNN article, of its last perfect credit rating. The move could rattle financial markets and push up interest rates, maybe, potentially creating an additional, it actually didn't happen in 2011. All right, we'll get to that. Potentially creating an additional financial burden for Americans already struggling with tariffs. All right. Of the three major credit rating agencies, Moody's was the lone holdout, maintaining its outstanding rating of AAA for U.S. debt. Moody's held a perfect credit rating. It now ranks U.S. creditworthiness one notch below that at A1, joining Fitch and S&P, which lowered theirs to same type of kind of the same rating. I'll get into the ratings in a second. By the way, what was Moody's waiting for? Like, it's not like this is a surprise that we got all this debt, that we've been running deficits for years and years. So were they like, I don't know, maybe this will be the year they balance the budget. So let's see. No comment from Treasury yet, at least according to this article. They do mention the stable outlook. It's still stable. It's quite strong. The ratings agencies noted that American system. All right, I don't read all this. You can go and Google it. Back in 2011, though, that was during Obama's term. So Janet Yellen was the Treasury Secretary. Was she Treasury Secretary or the chair of the Fed? Let's see. So then 2023 was Fitch. So S&P was first, then it was Fitch. I think I'm getting S&P in 2011, Fitch in 2023. And let's see. America was running a $1.3 trillion annual budget deficit in 2011, a number that has since risen to $1.8 trillion last year. So last year was 2024. And really, the way this works, so that actually was during Biden's term. This budget, so 2025 is still based upon the last budget, if they even passed the budget. So 2026 is really the first one that you attach to this administration. Although, as we know, you can spend money outside of a budget. Obviously, if they kept to a budget, there would be no deficit. Anyway, so let's see what else is in here. The Obama and the Biden administrations lambasted both of those decisions, 2011. In 2023, Janet Yellen said the decision was arbitrary and based on outdated data. All right, so I'm seeing a lot of stuff that's like, get ready for an absolute crash tomorrow. And look, I don't know what the market's going to do. The market could crash, market could not crash. Market could go up, market could go down. But I will tell you, back in 2011, yields did not spike. I went back and I looked, and that happened, I believe, August 5th. August 2nd of 2011, the yield was 2.66% on the 10-year. August 5th, so it was 2.58. August 9th, it was 2.20. I'm kind of moving my cursor along, and it's, the dates are a little scrunched together. I guess I could unscrunch it. That's even a thing. Rates actually continued lower, 1.72 on September 22nd, 2011, before moving back up to, I don't know, right around 2.4, moved down, moved up to 2.4, and then came down. And they didn't come up above that until 2013. So we didn't see any real response to that. And then the other question is, well, what did the markets do? Okay. So the markets, what did I say? So if I look, markets retraced a little there. Yeah, I think the markets retraced, not anything crazy, and then recovered, and then, were higher by November of that year. So, we'll see what happens on this. But again, it's like, what were you waiting for, Moody's? Really? And does anybody really, I mean, does it matter that much? I don't know that it matters that much, but it's a great headline. And 2011, 2023, now these, they went and did it now. So just a little bit on, there's 3 credit rating agencies. There's Moody's, S&P, and Fitch. And S&P and Fitch use the same letters. So AAA is 3 capital A's. Fitch is 3 capital A's. Moody's AAA is capital A, little a. And so AA plus was the next down, and that's what I think they're both at right now on treasuries. And then Moody's, second from the top, is capital A, little a, 1. So, they use a little different nomenclature there. So, for example, if you were looking at a triple C plus bond, let's see, S&P is triple C plus. Fitch just has triple C. They don't do triple C and triple C negative. And then triple C would be C, capital C, little a, 1. All right. You can Google that if you're interested. But look, I don't know if this, again, this is the third one. The first 2, it's like, oh no, if Moody's does it, then it's really, so I don't know. We'll see what happens. Remember, it's buyers and sellers that drive markets. If you have more sellers than buyers, markets go down. If you have more buyers than sellers, markets go up. Jay used to hate when I say that, but it's true. And we'll see what happens. That's why we like being hedged, because if we're not unsure about direction of markets, we're unsure if there's something going to come out and drive things downward, we like to have hedges in a portfolio. All right. So we'll see what happens there. And all right, one more thing on this. I would say it's very unlikely that the U.S. would ever default on the debt. But you could be getting paid back with dollars that aren't worth as much. So if your currency goes down relative to other currencies, that's the thing. All right, I'm done with this. Okay, one more thing. I swear this is it. I did an AI search because I just ran out of time to do the research on my own. And let's see. It says in 2011, the S&P lost 8% over the period from August 5th to early October 11th when the market bottomed. That's actually different than I saw in the chart. But anyway, this is AI. We'll see. And so the market substantially recovered, and within 6 months of the downgrade, the S&P 500 gained approximately 12%. Okay. In the 12 years following the 2011 downgrade, the S&P has generated an annualized total return of 14%. All right. Really, I'm done with this. Well, I'll let you know when I know. All right. The other thing that I want to talk about is, so the markets have recovered. I think I said last week, if I asked myself, or if anybody was asking me, do I think the lows were in for the year? I said, yeah, I think the lows are in for the year. And look, I'm not saying the markets can't go lower and markets can go up, markets go down. We just don't know. Remember what I always say, Wall Street thinks it knows, but it really doesn't. But I went back and looked, and, it got me thinking. JP Morgan's Guide to the Market has a great chart. And it goes back to, I think it's 1980 or 1979. And it says, despite average intra-year drops of minus 14.1%, annual returns in the market were positive in 34 out of 45 years. And they've got this great chart that shows the intra-year declines and versus the total calendar year return. So, for example, the market's positive again this year for 2025. I think it's up, 1.5%, 2% now, maybe right around 1.5%. But intra-year, it was down 19%. And I look at it and you say, well, it's down intra-year a lot of years and then closes up higher. In fact, some of the worst ones are minus 34% intra-year at the absolute low for the year. That was 1987. Market actually closed up 2% that year. That was a pretty violent move, 1987. That's the biggest, one day, couple day move. But then you look at 2008, and 2008 closed the year minus 38%. The intra-year low, it says, was minus 49%, so almost 50%. You look at other years. So last year, minus 8%, closed up plus 23%. Year before, minus 10%, closed up 24%. Year before, minus 25%, closed down minus 19%. So only about a 6% difference. That's actually one of the closer ones. That was, what was it, 25? That was 2022. So 2020, I mean, that was a crazy year, minus 34%, up 16%. But you look at this and you say, it's just uncanny. And can you imagine, this goes to kind of the idea that trying to time the market is a fool. It's really a fool's errand. Imagine at the low, somebody just said, I'm going to sell everything and I'm going to wait. I'm just going to wait. And they stay in cash. I mean, we know the stats. I won't go through them. You miss the best whatever days of the year. You're very, very impacted. You got to be right twice. You got to know when to sell and when to get back in. And, I mean, this recent action in the markets, look, nobody knew where the market's going to go. It was going to go lower, was going to recover. You don't know until you see it. But so far, it's really been a V recovery. And honestly, if somebody asked me, do we make another all-time high this year? Sure. I mean, we'll see if it happens or not. But if you're asking me, I'd say, yeah, there's a good chance we make another all-time high. I'll get to some of the margin stuff and earnings in a second. But I encourage people, JP Morgan Guide to the Markets. You got to throw an email address in. And I don't know. I mean, I think it's really geared toward institutions because you're supposed to put your work email in. And I don't know if but anyway, if you Google it, take a look there. It's a great chart. It's just kind of staggering how much intra-year declines there are in the market relative to where it actually ends up. All right. The other thing I wanted to talk about is, where should we go here? Consumer confidence and the market. JP Morgan's Guide to the Markets. I haven't gone to the well there in a while, so I thought I'd go there, and I was flipping through, and there's some interesting data here. This goes back to 1971. It's Consumer Sentiment Index and subsequent 12-month returns for the S&P 500 index. So a lot was made. I think for April this year, it was at 52.2. The average, well, I assume the average is 84.3. And then you have some highs where, Jan of 2000, it was above 110. Here's the problem with the sentiment indexes. People have bad sentiment when the markets are down. And, it's just the case. People don't feel great when the markets are down. So you look at some of these lows, February 75, May of 80, October 1990. Let's see what else we got. November of 2008. And we know the markets went down after that. August of 2011, bad sentiment. Oh yeah, remember what happened? That was the downgrade. And then you look and you say, so we don't know what's going to happen 12 months from now. But June of 2022, it was very low sentiment. It's actually below where it is right now, plus 17.6% next 12 months. August 2011, plus 15.4. November 2008, plus 22.2. Subsequent 12-month S&P returns, according to JP Morgan's Guide to the Market. May of 1980, plus 20%. February 75, plus 22.2%. And then you kind of look and you say, well, when it's really high, does that tell us anything? And, yeah, sure. January 2004, it was above 100. Next 12 months, 4.4%. Jan 2000, next 12, it was over 110. That was actually the highest reading on here, minus 2%. There's some odd ones too, like February 2020, which is right before the March COVID drawdown, plus 29%. Because remember, that was a V recovery that happened there. So look, the problem with sentiment is, and it's just like, think about how people feel or how you feel when markets are selling off. Usually people are more bearish as they're selling off. And we see it also. And here's the other thing. Sentiment is also driven by, these days, I mean, the divide if you look at Republicans versus Democrats versus independents, it's ridiculous. I mean, can those people really feel that different? And the answer is yeah. It totally flipped when Trump went in, won election or went into office. The Democrats said the economy is going to be bad, inflation is going to skyrocket. And when Biden was in office, Republicans said the economy is going to be bad. And by the way, markets did okay in all those cases. So then you kind of look and you say, well, is there anything you can draw upon in things like consumer sentiment, or is there any validity to it? And I don't know. I mean, the AAII, which, remember, that was super bearish, like one of the more bearish readings you had. And we've had a V recovery from that. So I think sometimes it's, and this is really investor behavior. It's the behavioral aspects of investing. People tend to get very bearish when things are bad. Sentiment goes way down. Often they sell at the lows and don't come back in. And, you look at 12-month inflation expectations, University of Michigan survey. It was something like 7.3%. I don't know when this was taken, but this is University of Michigan. Oh, the May 2025 preliminary figure, 7.3%, highest since 1981. So sentiment's down, inflation expectations a year forward. People think that over the next 12 months, 7.3% we'll go from like 2.4 year over year to 7.3. Okay, maybe. And let's see. This was from Charlie Bolello. Is my sentiment one that I was looking at? Was it not up to date? He's got it. This is the University of Michigan Consumer Sentiment Index. Okay. He's saying it was the second lowest reading ever. All right. This is different than the JP Morgan one. I'll have to investigate that. And June of 2022 was the lowest. And then we have, I guess this is May. So in June of 2022, how did the markets do a year later from that? You just have to kind of, I don't pay a lot of attention to the sentiment indicators any longer. I'm sorry. Although I take that back. Maybe they could be good contrarian. And look, I'm not saying the market's going to go up. This is why we buy. This is why we hedge. But I am a proponent of staying invested in markets. All right. Should we be bullish or bearish? Should we talk about good stuff, or should we try and scare you this week? Here's one. A DeGraff breadth thrust in the market. And this is, let's see, percentage of stocks at 20-day highs. Who is this from? This chart's from, is it HT Mount? There's a insignia here. I saw this on Twitter. But basically, it kind of says, when you get this indicator, 12 months post when this happens, generally markets are higher. The exception is 2002. Markets are minus 28% 12 months later. And then you look at, let's see, there was another one I was looking at. There's two breadth thrust indicators. Give me a second. Let me find my notes here. The DeGraff and, hang on a second, I'm getting it. Zweig and DeGraff breadth thrust. When they occur within 1 month of each other, this chart, I don't know why the earliest one is 1982, but 82, 84, 2009, 11, 13, 19, 23. And the average 1 year later is plus 26.12%. And 2 months later, 3 months later, 6 months later, 1 month later, again, very, very small sample size. And I don't know if they only looked at data going back to 1982 or whether they actually looked prior. My guess is these weren't around prior to 1982, both of them anyway. And 2 months, 3 months, 6 months, 1 year, all the times this has happened, going back to 82, markets are higher over those time periods. So again, anything can happen. And just because something happened before doesn't mean it will happen again. But, what's the old thing? History may not repeat itself, but it often rhymes. All right, here's another one. Charlie Bolello posted this on Twitter. Biggest S&P 500 rallies over 27-day trading days, 1950 to 2025. So 27-day return from April 8th to May 16th. So let's see, start of the S&P was 49.83, closed 59.58, plus 19.6%. This is the 15th highest in this list going back to 1950. And then you look at we have no idea what it's going to be 3 months, 6 months, 1 year, but they look at all these, and with the exception of 2008, where 3 months later it was minus 11%, every other time period is green. And in fact, the historical average of the top 14 rallies was, a year later, plus 41%. 5 years later, plus 140%. No idea if this is going to happen again. Don't trade off this. I'm just giving you some interesting stats that somebody posted. And I like to look at this stuff. When you look at markets, though, and what's working this year, gold, although gold is sold off a little bit, gold's up over 20% this year. Bitcoin, I hate to say it because, I'm not necessarily a Bitcoin fan. It's up 10%. And then you look at, large cap, which is kind of the S&P 500. It's up about 1.5% or so. And, still hanging in there, the developed international, plus 15%. Again, I don't know who had that on their bingo card. Oh yeah, I'm going to buy developed international going into the year. And even emerging markets still up 8.5%. So we'll see if those kind of revert back to if the U.S. markets are going to sort of catch up to those, or whether those are going to fall off. But, we'll see what happens there. The other thing is, it seems like, do I want to talk about this? Actually, I'm thinking in my head, do I want to talk about the second part? Let me start with the first part. Atlanta Fed GDP now is much higher than the consensus blue chip range of top 10 and bottom 10 average forecasts. So Q2, which is we're in right now, real GDP is just above 1% annualized estimate for what it will come in at. The Atlanta Fed GDP now estimate is more like, I don't know, I'm eyeballing this, about 2.4%. So does this mean anything? Well, it means the data so far that's coming in is showing higher growth. And what that's resulted in, I think JP Morgan's done this. There might be some other investment banks that have done this, but they have reduced their recession probabilities, or actually said that, for the year, we think that GDP is going to be positive. So it's kind of like the sentiment, right? All right. The second part I was going to talk about, I think Sam Rowe had posted something about, I can't find it right now, but Sam Rowe on Twitter is always good to check out, where it was so all the investment banks, remember, they do their end of December, they say, what's our 2025 year-end targets for the S&P? And there were people with 6,500. I think there was somebody with 7,000, all that stuff. And then they go and they slash their estimates when the market goes lower. So, it's just like sentiment. It's like, oh, the market's lower, we're going to slash our forecast. And if the market goes up, we'll move our targets back up. I've always said that targets are pretty useless. We do them. We do them in December. We have fun with it. We do it once, and then we go back in this year in December coming up, we'll make our new ones and we'll look at how bad we did on the old ones. But I always say that when you at the end of the year, when you're trying to put a target on the market, where you think a market's going to close, really you're trying to make a guesstimate about, on December 31st, the end of the year, what is the following year estimate for earnings per share. And then if you have that number, then the question is, what's your guesstimate for the multiple on those earnings? Do you see where I'm going with this? I mean, let's say I'm simplifying this for a second. Let's say you think, so it's imagine December 31st, 2025. And you're saying, I think at the end of 2026 that the S&P will be at 7,500, whatever the heck it is, right? But really what you're saying is on December 31st of this year, not just December 31st of the next year, you're like, what's the forecast for EPS? Let's say it's 300 and you think the multiple is going to be 25 times forward earnings. Okay, if it's 300 is the estimate for earnings per share and a 25 multiple, on December 31st of 2026, that's for 27. You see what I'm saying? These things are useless. And, you could get the earnings right, exactly right, what they'll be forward at the end of this year for 2026. But what you can't really figure out is what the multiple is going to be. All right. What else do we want to talk about this week? Margins. So this is another area I'm always fixated, or fascinated is the better way. And if you want to look at, over a 10-year period, and you say, where'd the market start? Where did it end? And what caused it to go up or down? What's the attribution? And you would look at revenue. You would look at margins. And if you have the revenue and you know the net profit margin, then you can do the math and get to the earnings. You can figure out whether shares are being bought back on a net basis. So companies issue them sometimes, for stock-based compensation. They retire earnings. But, earnings, or according to JP Morgan's Guide to the Market, 13.5% was Q1 25. Let's see, profit margin for the S&P. Not bad. It's not the highest it's been. I think it was just under 14%. Was it in 21? But it's up off what it was prior quarter. It's pretty strong. And if you look at the share of EPS growth, so annual growth broken into changes in revenue, profit margins, and share count, the total EPS growth is 9% right now for this quarter that we're reporting, right? Q1 that's being reported right now. And it's pretty well through except for NVIDIA. So maybe they do a blend of actual and still the estimates. But margin was responsible for 4.6% of the growth, revenue for 4.5% of the growth, share count minus 0.1% of the growth. So there are more companies that are tech-based in the S&P than there were 30 years ago, 40 years ago. So I've already gone through this, my thought. I mean, I think the fact that, in 2002, profit margins are 8%. They crested, in probably 2006, 2007-ish, right around 10.5%, went way down. They didn't break 11% until right around 2017. So profit margins have been steadily easing higher over time. And I don't think it's any secret when you have tech companies that have less CapEx. You're not a big factory. You're not a big oil conglomerate that's got to spend a ton of money to build plants and machines and all this other stuff. Or you could be Facebook and buy Instagram, and the rumor is they had 9 employees and $1 billion in revenue. So this is something to keep an eye on, and will profit margins come down? I think that's the question. So if you're the bear, if you're making a bear case on this market, you're saying that, well, forward P ratios are still elevated. Should they be higher than they were 30 years ago? Yeah, I'd say probably. But the bear case is that with some of the, and although the tariffs seem to be getting worked out, seems like we're going to get some deals where both countries can save face and they can both claim victory. That's my guess. And it kind of, gets figured out. But if you look at that and you're saying, well, these headwinds and maybe some other things are going to cause margin compression, meaning margins are going to shrink. And if your sales, even if your sales grow, but if your margins shrink, your EPS may go down. Or all else equal, your revenue stays constant, but your margins shrink, your earnings drop. So that's sort of the bear case right now, I think, in the markets that people are watching. So, but then you look at, something like, I don't know, the let's take the performance of the Magnificent Seven year to date. Well, the S&P is up, what did I say? A little over 1%. The S&P X the Mag 7 is up 2.4%. The Mag 7 is minus 4.7%. And so it's still driving the returns. It's still driving the returns quite a bit. But then you look at earnings growth year over year, and you look at for 25, it looks like the estimate is Mag 7 to grow 17%, the S&P X Mag 7, 7%. And remember, all of the earnings are aggregated together and they're put into a pot. So if you have one massive company bring in all the earnings, it all just goes to the earnings per share on the S&P 500. But until proven otherwise, this is the question. Do margins hold up? And our earnings estimates, are they good? Are they good? Do the analysts have it right? Are they too late in revising them? This is sort of the bear case that's out there. And I would say so far, the earnings have been pretty good that got released in Q1. I think most in normal years, I think most companies do beat earnings. But that if you're bearish, if you're trying to make a bear case, I think you go to margins there. Let's see. This is a chart from NDR. I don't know who those people are, but it looks like a bull and a bear going opposite ways and a line down the middle of their logo. But they put a chart out, and they have S&P 500 4-year cycles. And so far, the actual S&P through 5/12, and then the typical post-election year average. And if you look, it's actually kind of through April. It's really interesting. So year to date, we bottomed. Well, again, if it's the bottom, if it winds up being the bottom, but so far this year we bottomed in April. And you look at this post-election year average in sort of these 4-year cycles, and typically markets are lower from January to April, and then it turns up in May. And we're kind of tracing along that line right now. And it looks like August is on average where markets peak, and then they kind of come back down into November or so. So I don't know if this is going to be the same thing this year, but I just thought it was interesting enough to mention, because markets, the cycles and the post-election year and the midterm year, all that stuff is, you kind of look at the averages and yeah, anyway. All right. Inflation real quick. Daniel Lacal on Twitter had put a chart of velocity of M2 money stock. So velocity of money is just a fancy way for saying if you go and buy a paper for $1, and the guy who owns the newsstand then takes that dollar and goes and buys a slice of pizza, and the pizza shop owner takes the dollar and buys a toothbrush, and so on and so forth. It's how fast is that same dollar being spent in the economy. And one of the things that economists might point to is if velocity of money is really going higher, you would expect that to be inflationary. And actually what we're seeing is velocity of money sort of crested in Q3 of 2024, and then it's been sideways and slightly down through Q1 of 2025. I thought it was an interesting chart to look at, and this was from Federal Reserve Bank of St. Louis. So we're not seeing velocity thus far, at least in M2 money stock. And I think it goes to the point I've been making. And, PPI came in less than expected, producer price index. Inflation is 2.4. The question is, okay, are we going to get a big print for May? Well, the inflation nowcast is actually not saying so far based upon the data, we're going to have a massive inflation print. And, sometimes here's the other thing. If tariffs caused a reduction in demand and there's less buyers of products, does that hold prices maybe lower than people think? I think that could be the case. And maybe people bought everything in January and February ahead of the tariffs, and right now demand's lower, and so inflations aren't necessarily going higher. I think Walmart mentioned that they think they'll be raising their prices, but are they using this as an excuse to raise prices, or is it just no? Actually, we're paying a lot more for our input cost, and so Walmart's a good one. I think Target reports this week. There'll be another one that's interesting to keep an eye on. All right. Last week I asked the question in the podcast, MicroStrategies and the S&P 500, and I went through. Of course, they don't have 2 consecutive quarters of being profitable. I've been reading that there might be some changes in the counting on how you sort of mark gains on assets that you're holding. I mean, they're holding Bitcoin. I think there was it's slipping my mind right now, but somebody came out and they suggested shorting MicroStrategies and buying Bitcoin because the value of MicroStrategies, the market cap is worth more than the Bitcoin that they hold. So that was a trade that somebody else did, I think they recommended. And I'm not telling you to do that. I mean, if you want to do it, do it. If you don't want to do it, don't do it. Doesn't matter to me. But one of the things I find it interesting because it would be, I think I said, about the 85th largest company in the S&P 500. And literally it's just Bitcoin. And whether it goes up with Bitcoin or whether the relationship breaks and it goes down when Bitcoin goes up because people are saying, well, why am I paying this much more for the Bitcoin they hold? Well, Coinbase, and I mentioned the extended markets Vanguard index, which is below all the companies not in the S&P 500, kind of the next 1,500 in the Russell 2000. And one of the companies, the biggest companies in there, Coinbase, they made it in. So, you have DoorDash, the previous round, and then you have Coinbase and this one. And this also goes back to the idea of these are tech companies. And, I don't have Coinbase's earnings or margins or anything up in front of me, but so I thought it was interesting that they got it. We just talked about it. And I'd forgotten they were actually going to, well, I shouldn't say, I didn't know necessarily they were going to make that announcement. Remember, there's a board or a committee that does that at S&P, and they decide what's in there. And I always say that the S&P 500 is actually, it's actively managed because people are deciding what to put in there. They've got rules around it. But anyway, if you want to go back to last week's, I'll put it in the show notes. You go back to last week's episode and I talk about what the criteria are to get into the S&P 500. All right, recommendations this week. I finished season 2 of The Lincoln Lawyer. I've got a 3rd season, although I think I've seen the end because my wife was watching it. So I wonder if when I start getting through the episodes of season 3, whether I'll be like, oh, I already saw this. So, and I think it's good. I may have mentioned it before, but it was hard at first to separate from the Matthew McConaughey movie, which I thought was really good, The Lincoln Lawyer. So if you haven't seen that, that's a good one too. Obviously, it's a different cast. I shouldn't say obviously, but no, it's not Matthew McConaughey. It's somebody else. It's pretty good. And then the hockey playoffs continue to just be fantastic. Last night, the Florida Panthers, lost 2-0 to the Toronto Maple Leafs. And so there'll be a game 7. I don't know if this will be out before the game, but if it is, I'd encourage you to check that out because that will be a heck of a game. And, so definitely check out the NHL playoffs, The Lincoln Lawyer. I thought that was good. And I'll try and come up with some new stuff next week. All right. That's it. We did it. We got through it. Send me emails. Derek.moore@zegainvestments.com. That's DEREK.MOORE at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly. Derek.moore@zegainvestments.com. Send me emails. I like getting emails. And let me know if there's any topics that you want us to cover on the show. And that's it. All right. Good luck this week. We'll talk to you next week.